Hello and welcome. My name is Camilla Jones and I'm joined by the small cap team today to talk stocks. We've got Cooper, Sean and Sam. Sam, we'll start with you, EVT Group. Do you like them?
Yeah, we do. We rate it as a buy at the moment. EVT is a conglomerate that owns cinema assets, Threadbow and obviously hotel assets as well. What we find really interesting in the market is the fact that the stock is currently capped at about a $2 billion market cap, but it's got about $2 billion in net property, net of debt, on their balance sheet. So the operating business is effectively priced for free. In February, they made their first mention about divesting property assets, including 525 George Street, if anyone's been to that cinema. And we think they will be able to divest those assets and redeploy that into the high returning hotel part of the business. Ultimately, the market will shift from valuing this as a multiple of its property towards valuing the operating business over time, and that's why we think the stock's a buy.
Okay, thank you. Sean, we'll go to you on Judo Bank. Do you think they're a challenger for the Big Four?
We do, yeah. So Judo's a buy for us. So the business is essentially a lender into the SMB segment of the market. They're currently about 1.5% market share. Management have done a great job over the past 18 months in terms of progressively de-risking their FY27 at scale targets. We think looking forward from here, as you see interest rate cuts start to filter through the domestic economy, improvement in the SMB segment, those targets will, become more real in investors' eyes, and that puts the business on about 6-7 times PE versus CBA on 25 times and growing, significantly stronger. So we think Judo can double from here over the next 12 to 18 months. So it's a buy for us.
All right, Cooper, you've just returned back from WA. Were there any companies there that stood out to you?
Yeah, lucky enough, got to go to WA for a conference and did a few meetings either side of the conference. One of them was Duratec. They're an asset maintenance and kind of specialist construction company. They do basically work across a number of different verticals, defence, mining and industrial, energy, and also building and facades. They're all going reasonably well, but the one that a lot of investors focus on at the moment is defence. Luckily enough, we got to go down to HMAS Stirling, where they're expected to spend a lot of money to take delivery of AUKUS submarines and just generally be a beneficiary of the increased defence spending that's going to come through hopefully in the budget tomorrow night. We think that is going to come through over time. Timing is always a little bit sceptical with defence stuff, but it will come through over time. What I think the market is missing with Duratec is its energy business. I had acquisition in 2022 of WPF and then a subsequent acquisition of GF Engineering early last year. These businesses have given them scope to the energy business and they work with clients such as Woodside, Chevron, Santos, etc. They've really put a lot of work into this division. Going forward, they've got ties with these companies now and they'll expand their services, and we're really looking forward to seeing that energy division grow, much like the mining and industrials division did for Duratec. So it's a buy for us, one to look out for.
Fantastic. Okay, let's turn to auto with you, Sam. Bapcor, firing in all cylinders.
They aren't at the moment, but we believe they can be in the future. So Bapcor is a buy for us. At the moment, it's trading at 15 times PE with a solid balance sheet. Historically, it's traded anywhere up towards 18, 20 times PE previously. We believe finally the business has the right CEO to actually turn this business around, which has suffered for many years from mismanagement. Effectively, the opportunity to improve margins, divest non-core divisions, take cost out of the business and ultimately improve returns is what we're after. The new CEO has the right pedigree. He was, the specialist who turned around the 7-Eleven business before that ultimately got bought out. And so we're really excited to see what he has to deliver when it comes up to their investor day at the end of April. So it's something that we're looking out for at the moment. Margins are well below where they should be in the past, and we think Bapcor's a buy.
All right. Sean, SRG Global, we've spoken about them on here before. Maybe you can remind viewers what they do and are you positive on them?
Yeah, so SRG is essentially an industrial mining maintenance services provider. We think the recent pullbacks provided an attractive entry point, so it's a buy for us. I mean, in hindsight, there's probably a bit too much fast money chasing this stock on, potential earnings upgrades and index inclusion. We've got both of those, but I think what the market's missing going forward is the ability for these guys to grow at mid-teens organically over the next few years. The balance sheet's net cash, they continue to layer in M&A, and you've got it trading on around 10, 11 times PE versus listed peers on average that are at 16 times now. So we think, there's a really good buying opportunity in that one at the moment.
Cooper, back to WA, is labour still tight there, and what are your thoughts on Mader Group?
Yeah, so labour is progressively getting a little bit better. Mader Group were traditionally a provider of, I suppose, tap-on, tap-off labour. So when mining services need to do shutdown work, etc. But they've grown their business now and are much more diversified than that. And they also offer specialist kind of capability. So their leverage and I suppose their stock share price moving based on the labour pool and labour availability in WA has somewhat decreased. They had a little slip in the last result because they expanded into North America and it hasn't gone so well. There's a bit of a difference between how USA in particular operate and service all their mining industry versus Pilbara. It's a lot more kind of remote work, and so they're finding that was a bit difficult to get in and really base themselves on site in the USA. They've since found the market in Canada, which is very similar to West Australia, where there's a lot of remote work. They need a lot of tap-on, tap-off labour, and also they're very quick at making decisions. So we've seen a lot of heads. I think there's 520 or 530 heads in North America at the moment. 300 of those are now situated in Canada, and I think they're growing at 20 heads a month at the moment based on what the company is saying and what the ad data is in the market. So it looks like it's a very strong market for them to grow into. If they can, I suppose, quash the concerns around North America with the Canadian rollout, then I think you can see this company go back to its previous multiple, which is around 25, 30 times, and it would see a significant re-rate in the share price.
All right, we'll go from labour to home improvements. Beacon Lighting, good news coming out of there?
Yeah, we believe it is. So Beacon Lighting we've talked about before. It's the lighting and fan brand that people know a lot about. What's fascinating about this business and what we've been tracking for some time is that they've really incubated a highly successful trade business within the broader Beacon group. You know, trade is, we look at trade as akin to the likes of the highly successful Reece Plumbing Group and what they've been able to achieve in Australia, and we think that Beacon is on a path to doing something similar. Trade represents over a third of sales now. It's growing 20% per annum, like without a hitch, and it's actually significantly accretive to the store economics that Beacon's enjoying at the moment. So stock's trading on 18 times P if you look out a couple of years, versus Reece and other sort of highly successful trade-oriented businesses at 25 plus. We think the stock can continue to re-rate over time as they deliver to this strategy. It's a buy.
All right, Sean, Ingenia Communities is one of those companies exposed to the housing theme. What are your thoughts on the company?
Yeah, we like this one. We think it's a buy. I mean, management have been there for about 18 months now, and they've done a great job in terms of driving improvement in the development returns in the land lease business. From here, you've got HMC Capital as a significant shareholder, and we think those guys are going to really do their best to drive value across the portfolio, whether it's something to do with a divestment or a capital injection in the holidays business. Then ultimately, we think there's broader strategic appeal around the land lease business with other listed parties in the market. So yeah, we think this one's still got good organic growth potential, but then also plenty of optionality around the asset base and where that goes. So we like it.
All right, Cooper, this next one, Energy One, it's now held in the new Wilson Asset Management Founders Fund portfolio. Why do you like the company?
Yeah, it is. Yeah, it's a new entrant into the Founders Fund portfolio. Its management and CEOs hold over 45% of the stock already, so it's good alignment with shareholders. What they provide is mission critical software for energy traders, and they have a dominant position all around Australia. They provide services for a lot of the major energy traders. They've recently expanded into Europe. They did that actually at an unopportunistic time just before Russia invaded Ukraine. So they've had a couple of years where they've worn increased headcount, waiting for that market and the energy market to come back in Europe, and it is doing so now. So they've increased that headcount, and now they're ready to take advantage of the growth that should come through in that market, and we are seeing signs of that. Their management are generally really conservative on how they guide the market, and they have been so through their whole listed period. For the first time ever, they gave us kind of numbers that they expect to hit going forward, and it's between 15 and 20% growth with really strong cash EBITDA margins. So if the company actually delivers on what they've guided to the market, it's a material re-rate from here. So yeah, it's one that we hold in the Founders Fund, really like.
Great, thanks Cooper, and thanks Sam and Sean. For more stock picks, please follow us on social media and subscribe to our emails.